kecil ya pasti kalah. Itu untuk orang kecil itu biasanya sama dengan judi itu. Nanti harga saham.
Hi, I will make you rich. I am an investment manager, powered by an artificial machine. Are you finding it difficult to identify supply and demand zones? Do you keep losing money in the stock market or struggle to figure out which stocks can help you make a profit? Struggling to analyze the market structure? This often happens because big players, with vast amounts of money, manipulate the market to their advantage. They can influence news and deceive investors, distorting the demand and supply curves in the stock market. Here's a common example of how the market is manipulated. A few wealthy individuals, controlling billions or even trillions of dollars, are aware that a company's financial performance is strong. However, they spread negative news about the company, causing widespread panic among investors. People sell their stocks in fear, driving the price down. Once the stock price drops, these wealthy individuals buy in at a low price, causing the price to rise again. By repeating this cycle, they continue to grow richer at the expense of others. To avoid falling into their trap, it's crucial to understand market structure, the secrets of trading using demand and supply zones, and the support and resistance levels. Don't forget to subscribe below and follow us to gain more free financial education. In our upcoming videos, we'll guide you on how to effectively analyze a company's financial statements and trade stocks like a pro, helping you avoid being manipulated by fake news. If you don't subscribe, you might miss out on valuable updates from us. Before that, you need to understand how the demand and supply curve forms the market structure by reading the technical analysis through the lens of demand and supply curve analysis and price action trading. These two concepts are powerful tools for understanding market behavior and making more informed trading decisions. Let's dive in. The financial markets operate much like any other marketplace. At their core, prices move based on the balance, or imbalance, between buyers and sellers. Demand and supply zones trading secrets is the foundation of price movement. Basically, buyers is the demand side, while seller is the supply side. When demand exceeds supply, prices rise. This means there are more people willing to buy at this point of time. Conversely, when supply outpaces demand, prices fall. This means there are more people willing to sell at this point of time. These movements create the peaks and valleys on the price charts that traders analyze every day. In technical analysis, we translate these concepts into demand zones and supply zones on a price chart. A demand zone is a price level where buying interest is strong enough to push prices higher. This often appears at the bottom of a trend or near key support levels. This is typically when you should buy the stocks before the price starts to rise. Because trader will often think, the price is already selling at discount while the stock's intrinsic value is much higher, so the price will rise. A supply zone, on the other hand, is where selling pressure is strong enough to push prices lower, typically found near resistance levels or at the top of a trend. This is typically when you should sell the stocks before the price starts to fall. Because trader will often think, the price is already selling at a premium level while the stock's intrinsic value is much lower, so the price will fall. Let's delve deeper into this. A group of wealthy individuals with significant influence over the government and the central banks can manipulate interest rates to serve their interests. If interest rates rise, the stock prices of the major companies they own typically decrease. To mitigate this, they use their media influence to spread news about an interest rate hike, creating a broader market sentiment that drives down the stock prices of companies they don't own as well. This sentiment encourages investors to shift their money to the treasury and bond markets, increasing the supply of stocks in the market and ultimately driving the stock index lower. Now that you understand how prices are shaped by the interaction of demand and supply, it's crucial to recognize how major institutions like private equity and venture capital firms can manipulate stock prices. These powerful players, armed with significant capital, media influence, and even control over central banks, can sway the market by dumping large quantities of shares, spreading news about interest rate changes to drive prices down, or making bulk purchases to push prices up. Being aware of this ability to influence price movements is essential for anyone navigating the stock market. That's why it's called market structure, because, essentially, only a handful of people have the power to structure the market and influence how the market operates. You may be familiar with the famous phrase that underpins capitalism: the rich get richer, and the poor get poorer. This sentiment was strongly reiterated by the President of the Republic of Indonesia in his recent statement. When it comes to stock trading, if you're not wealthy, you will certainly lose. For ordinary people, it's no different from gambling. So, it would be wise to hit the share button below and help spread this information. The more people who understand how the demand and supply curve works, the more efficient market structure pricing can become and the harder the stock market to be manipulated. Let's make this knowledge go viral. But don't worry, we've developed a powerful artificial intelligence that can predict price trends and market movements. Visit iam-aam.com, where our AI analyzes a company's financial statements, news, and price chart patterns to help you predict the next movement of your stocks and make informed decisions. By taking into consideration of the demand and supply zones, trading secrets, and market structure patterns. Before that, you will need to know what is the essence idea of a market structure, where the global elite determines which stocks will rise, fall, or remain in consolidation. In essence, market structure refers to how prices move in trends and patterns. At its core, it consists of three key phases: uptrend, downtrend, and consolidation. An uptrend is when the price consistently makes higher highs and higher lows. This typically signals strength and bullish momentum in the market. Buyers are in control. Typically, you are recommended to buy these stocks. A downtrend is the opposite, when the price forms lower highs and lower lows. This indicates weakness, with sellers dominating the market. Typically, you are recommended to short sell these kinds of stocks. And finally, we have consolidation, where prices move sideways within a range. This is often a pause, as the market decides whether to break out or reverse its trend. Typically, you are recommended to hold these stocks for a short-term period of time. Recognizing these phases helps traders and investors identify key opportunities. For example, in an uptrend, buying at support levels can align with the market's momentum. In a downtrend, selling rallies or avoiding long positions could be wise, but here's the key: market structure isn't static. It evolves. A strong uptrend can reverse into a downtrend after a double top, or a consolidation might precede a breakout. Being able to spot these transitions is what separates a skilled trader from the rest. Now, let's connect this to support and resistance analysis. Support and resistance trading is all about studying historical price movements without relying heavily on indicators. It focuses on candlestick patterns, chart structures, and key levels like those formed by demand and supply zones. Support and resistance in the stock market. Support and resistance are key concepts in technical analysis, used to identify potential price levels where a stock's price may reverse its trend. Support level. A support level is a price level at which a stock's price tends to find support or bounce off. It's often seen as a price floor where buying pressure exceeds selling pressure. When a stock's price reaches a support level, it may stabilize or even rebound upwards. Resistance level. A resistance level is a price level at which a stock's price tends to encounter resistance or stall. It's often seen as a price ceiling where selling pressure exceeds buying pressure. When a stock's price reaches a resistance level, it may stall or even reverse its upward trend. Remember, support and resistance levels are not guaranteed. Market conditions can change rapidly, and these levels may break. It's important to use other technical indicators and fundamental analysis to make informed trading decisions. By understanding and applying support and resistance levels to your trading strategy, you can improve your decision-making and potentially increase your chances of profitable trades. Why are support and resistance important? Identifying potential entry and exit points. Traders can use support and resistance levels to identify potential buying and selling opportunities. Understanding market sentiment. Support and resistance levels can provide insights into market sentiment and the balance of buying and selling pressure. Managing risk. By identifying support and resistance levels, traders can set stop-loss orders to limit potential losses. To summarize, technical analysis through demand and supply zones helps you understand where the big players, like institutions, are likely buying or selling to form the market structure. Support and resistance analysis adds a layer of precision by helping you time your entries and exits based on real-time market behavior. When you combine these strategies, you're essentially aligning your trades with the natural flow of the market. Mastering demand and supply analysis with market structure and support and resistance trends takes practice, but it can transform the way you approach trading. Remember, it's not about predicting the market, it's about reacting to what the market tells you. To navigate this, you need to analyze a company's financial performance and chart patterns. Buy when the stock is in the demand zone or at a support level, and sell at the resistance level if you're a short-term trader. For long-term traders, sell when the stock reaches the supply zone. If managing all this feels overwhelming, visit www.im-aam.com. It can guide you in identifying the right stocks to buy and sell at the perfect time. If you found this video helpful, please like, share, and subscribe for more trading insights. And as always, trade smart and stay disciplined.